Welcome back to another explainer. Let's get right to it. Today, we're demystifying Dynamics 365's project management and accounting architecture. I know it sounds dense, but if you've ever looked at your system and thought, how exactly does a project get from day one setup to actual recognized profit in the bank, well, you're in the right place. We're going to map out the exact financial and operational workflows that take an idea and turn it into real recognized revenue.
Okay, let's dive into this. We've got a very logical step-by-step flow today. We're looking at choosing your deployment type, contracts and billing rules, physical versus financial postings, mastering project invoicing, and we'll wrap up with recognizing your revenue.
Section 1. Choosing your deployment type. We have to start at the foundation, right? This is the very first and honestly absolutely crucial choice you'll make in your project lifecycle, figuring out where your capabilities are actually going to live. And fair warning, you can't really just hit undo on this later. You've essentially got two main paths. First up is Project Operations Core. This is your go-to if your business is strictly services-led. You get all your sales processes, resourcing, time tracking, and basic pro forma invoicing. But, and this is a massive but, it does not use Dynamics 365 Finance as the accounting engine. On the flip side, we've got Project Operations integrated with ERP. If you need deep, rigorous financial control, this is the one. It hooks directly into D365 Finance, which unlocks the heavy-hitting stuff like complex invoicing, work-in-progress tracking, accruals, and full-blown revenue recognition. Now, depending on your specific setup, there are a couple of other flavors you might need. If your world involves physical goods, Project Operations for manufacturing is what you want. It adds in all the support for stocked products, production orders, and the whole inventory shebang. Or if you're a heavy project-centric shop and you are just entirely sick of doing your month-end forecasting in clunky, disconnected spreadsheets, you'd look at something like Plan Automate. That gives you deep schedule-to-budget governance, forecasting, and month-end control directly inside D365 Finance. It's all about matching the tech's architecture to your actual business model. Section 2. Contracts and billing rules. Once we've got that deployment foundation nailed down, we have to build the contractual foundation. This is what's going to control your entire invoicing process later on. Dynamics 365 gives you a handful of very distinct billing rules, which basically put up strict guardrails around what you actually bill your customer. You've got milestone billing, and this one is strictly for fixed-price projects. You hit a specific date or deliverable, you bill. Simple. Then there's progress billing, where the system figures out the percentage of completion based on your budget versus actuals. Unit of delivery is exactly what it sounds like, billing based on specific quantities delivered. And of course, standard time and material lets you control exactly which categories are chargeable, right from the contract level. Now, what's really interesting here is the fee billing rule. It's a bit different. It doesn't just stand on its own, it provides a way to literally layer an extra markup charge, like a specific percentage, right on top of an existing billing rule. It's an absolute game changer for handling admin fees or standard markups, because you don't have to go in and manually recalculate every single invoice line. Section 3. Physical versus financial postings. Okay, this is where the magic really happens behind the scenes. I want you to think of this as a two-track system. A project is a living, breathing thing, right? And it travels along two parallel tracks, operational reality and financial reality. Dynamics 365 keeps these deliberately separate. Physical postings are your operational track. So imagine a truck rolls up and you receive a pallet of raw materials into your warehouse. Tracking that receipt, that's a physical posting. It tracks the movement of stock, so the logistics team knows exactly what's on the shelf. But, and this is key, it has absolutely zero impact on your general ledger. Financial postings, though, are the financial track. This kicks in when the actual vendor invoice for those materials lands on your desk and gets processed. That's what updates the general ledger, impacts your cost of goods sold, and actually hits your financial statements. But how do you handle the limbo between receiving the goods and getting the invoice? That's where clearing accounts come in. Think of these as temporary holding zones. When you receive those materials, the estimated cost might park itself in a purchase accrual clearing account as a liability. Then, later, when the real financial invoice is posted, the system sweeps that balance out and moves it officially to accounts payable. It basically keeps your books perfectly balanced while the real-world operations keep moving forward. So, the crucial point is, how does the system know where to put all this money? Well, D365 uses a posting profile hierarchy. It's like a giant sorting mechanism. When a transaction happens, the system looks for a home for it, starting from the absolute most specific rule and zooming out to the most general. First, it looks at the table level. Is there a rule just for this one specific customer? If no, it moves up to group. Is there a rule for this broader type of customer, like external or intercompany? And if there's still nothing, it catches everything at the all level, which is just the default ledger account for everybody else. It's an incredibly smart way to handle massive accounting complexity without having to build a million individual rules. Section 4. Mastering project invoicing. All right, our transactions are routed properly, so now it's time to actually bill the client. For time and material projects, the way Dynamics 365 handles accrued revenue is a huge deal. Let's say one of your consultants works 10 hours this month, but you're not scheduled to bill the client until next month. The system lets you accrue that revenue right now, recognizing the work as work in progress, or WIP. Then, when it is finally time to cut the real invoice, the system uses project subledger exchange rates to automatically and precisely reverse that original accrual. It completely eliminates the risk of double counting your revenue while still giving you a real-time pulse on your project's profitability right now. The actual day-to-day workflow for generating that invoice is a really clean, chronological process. Step 1. You spin up an invoice proposal. This sweeps up all your billable hours, expenses, and fees based on those billing rules we set up earlier. Step 2. Your project managers review and modify the proposal. Maybe they spot an expense that shouldn't be passed on just yet, so they hold it back. Finally, once everyone signs off, Step 3 is posting it to the invoice journal. That's the exact moment it officially becomes a customer-facing invoice. Dynamics 365 also brings some pretty heavy-duty advanced features for complex billing scenarios. You can manually override due dates right on the invoice proposal if you need flexible payment terms on the fly mid-project. For the really big enterprise operations, it uses multi-threaded batch posting with something called late selection. This is actually brilliant. It means that when your automated batch job runs, it grabs data at the exact second it executes, meaning it will catch brand new invoice proposals that someone might have created just seconds beforehand. And hey, if you're working on a project that's funded by multiple grants or organizations, you can use custom funding rules to automatically slice up and allocate those transactions across the different funding sources. Section 5. Recognizing your revenue. We've made it to the final and probably the most highly technical stage of the whole life cycle, recognizing the revenue and closing the books. With fixed-price projects, you're usually choosing between two main accounting principles. First is percentage of completion. This is where you recognize revenue progressively as you accrue work and hit milestones against the contract value. The second route is the completed contract method. With this one, you hit the brakes on revenue recognition entirely. Every single cost just sits in your work in progress account until the project hits absolute 100% completion. Why do that? Well, a lot of businesses use this highly conservative method for strict compliance. They want to absolutely guarantee that zero profit is claimed until every single contractual obligation is met. And this brilliantly illustrates exactly how that completed contract method flows through the general ledger. During journal posting, your costs debit the WIP account. When you generate an invoice proposal for a milestone, it hits accounts receivable, sure, but the credit goes to deferred revenue, not your actual revenue account. It's only at the very end of the project, during revenue recognition, that the deferred revenue finally moves into your actual revenue account. And then that final elimination step clears out your accumulated WIP costs and moves them over to cost of goods sold. Let's move to how this all builds into the final process inside the system to actually close things out. To finalize the financial life cycle, you create an estimate and set it to 100% complete. Then, you post your final WIP or accruals. If you need to, you reverse any already posted WIP to make adjustments. And finally, you hit eliminate. This clears all those lingering WIP balances directly into your profit and loss accounts. It permanently flips the project estimate status to eliminated and safely, cleanly closes out the project's financials. We have covered an immense amount of ground today, tracing this whole project lifecycle from the very first deployment choice all the way to final revenue recognition. So I want to leave you with a question to chew on. Does your current Dynamics 365 financial governance actually match your operational reality on the ground? Or by relying on manual workarounds and misaligned posting profiles, are you leaking profit in the gap between them? Use the structured approach we went through today to take a hard look at your own setup and optimize your project automation. Thanks so much for joining me on this explainer, and as always, keep learning.